everyone. Thanks for joining us today. We'll let a few more in as the number keeps going up. But happy Valentine's Day to everybody. Apologize for the technical difficulties getting everything started. I could say I was getting the absolute perfect gift for my wife as I was waiting. But that's not the case. No, just trying to figure out the camera and getting it all set up the right way. But before we get started, yeah, hope everybody's having a wonderful start to their Valentine's Day, and you're treating your special somebody or yourself, for that matter, really well today. So hope everyone has a wonderful day. But I don't think we're here to talk about Valentine's Day per se. I think it just happened on that. But I mean, tax savings, right? There's nothing more that spells love than tax savings. So we'll get into a little bit of that today, why Roth conversions may make sense for your financial plan and why it might not make sense for your financial plan. So I'm excited. I think we're going to have a really good discussion today. We'll have the Q&A box that's opened. If you've joined my presentations before, I typically will answer those questions along the way. If not, then at the back end of everything. So feel free, if you have any comments, please let me know. And happy to address that. So Roth conversion planning, the topic is we're going to be covering today. And let's go to the next screen here. Let's go. Okay. So before we jump in and talk specifically about why Roth conversions, what are they? What are the benefits? What are the pitfalls? Step back. Let's talk about Bogart Wealth as a firm and how we may be able to assist, as this could be an integral part of your overall financial plan. Bogart Wealth is a registered investment advisory firm. Now, we're located where I am right now in McLean, Virginia. We have over 1,250 households that look to us as their primary financial advisor. So when clients have big life decisions to make, my goal is that I want to be the first person that they contact in order to assess, is this something I should be doing, or how should I be thinking about this? And it's going to come back to their financial plan. We'll talk a little bit about that in a few minutes. We do hold ourselves accountable as fiduciaries. That term is used very heavily around the offices, and always making sure that we're acting in our client's best interest at all times. I myself am a certified financial planner, vice president financial advisor with Bogart Wealth. I've been in the industry for about 17, 18 years now. I've been with Bogart Wealth for about 2 years. But as you'll see is the majority of our financial advisors at Bogart Wealth that you would be working with, or ones that you already are working with, we do hold the certified financial planning designation. As an advisory firm, we like to use a custodian to, have our clients' accounts at a major custodian, and we use Charles Schwab. Like Schwab's platform, their trading integration. And one of the things that makes Bogart Wealth stand out, as we're talking about, hey, there's a lot of good firms that are out there. What makes Bogart Wealth so special? What's that secret sauce that they have there? It's really the integration of comprehensive detailed financial planning, investment management, and then tying in that tax integration perspective. Roth conversions that we're going to be talking about today can be very impactful, but that's just not it. There's a lot other things that can go into your tax planning. In fact, we, depending upon your situation and size, we can actually look at either running intra-year tax estimates, or even working with a CPA team that we're affiliated with to help with tax prep, tax filing. So a lot of that is integrated with what we do, and I think that makes us very unique and very special as a value add. One last thing, as you'll see on the screen, transparency. We only get revenue from what our clients pay us to manage assets. We don't take revenue fees for mutual funds. We don't charge commissions on trades, things like that. So as holding ourselves accountable, we are completely transparent in our pricing. This slide is a little outdated, because what you don't see on the left-hand side is the new Bogart Wealth name on the McLean, Virginia building. We are very proud of that and excited to see that that's gone up. Hopefully we'll get that updated for our next slide. But we do have presence not only in Northern Virginia, where me and my family live, but also in Houston and the Woodlands as well. So if you're down in the Texas area as well, we have you covered with 2 offices down there. So hop by and see us. What I mentioned to you before, hey, we have a lot of certified financial planners on staff, led by James Bogart, our CEO, who's also a certified financial planner. But look at the breadth of the offering here that we have from advisors. So if you are partnering with us, or you're questioning, hey, should I be contacting Bogart Wealth about, looking at a comprehensive financial plan? There's just a breadth of advisors that we have here from different backgrounds, different walks of life. So at the core of it, if there's something that we need to help as from a team perspective, we're absolutely more than happy to help. And just some really good-looking people here. Everything we do at Bogart Wealth is done in-house. What I think is really special about what we do is that not only do we have our advisory team, here in not both Northern Virginia and also in Texas, but we also have all of the different levels of the firm that you would need, like your compliance team, your marketing team, your financial planning team, and operations. That's all done in-house. So if I have a question about what's going on with your accounts, or maybe we need to make an update to beneficiary, I will just literally pop out of my office and talk to Luke, who's assigned to work with me, about, hey, let's get this done. How's the quickest way we can get this taken care of? So kind of cuts out a lot of the red tape that you have, especially, if you're accustomed to getting some service done, you have to call a 1-800 number, you wait on hold, and that just takes forever, and you call back and you get somebody different. Here, it's going to be that same personal touch, that high contact that we have here with our clients. We're not talking too much about the investments today and the investment strategy behind it, but that is a very big core part of what we do as an investment firm. We're talking a lot more of the planning side of things today, but Alex Spencer is our Chief Investment Officer. He is a CFA designate, and then he has his team led by Hal and Brendan as well, both CFAs and charter market technicians on their own behalf. So everything we do from an investment perspective is also done here as well. Okay, so that's Bogart Wealth in a very small, short period of time and window. Certainly, there's a lot more to know about. If you have any questions about the firm, don't hesitate to reach out to myself personally, and happy to answer that. Let's get into how Roth conversions fit into what Bogart Wealth provides to all of our clients. And that's detailed, comprehensive financial planning. You look at a firm, an investment firm, you might think, okay, investments, stocks, mutual funds, that and the other. That's just not it, though. What we look at as a fiduciary is how all of these facets that you see on your screen right here fit into your financial plan. So it's assessing where you stand big picture-wise, whether it's, hey, I want to start saving for retirement. And I'm getting closer. I got to start thinking about what it is and how I'm going to be taking monies and which accounts and how much, what's my tax situation. And then it's the other walk of life. I've had a great career, great family. Now it's sort of at the tail end. How does the estate part figure all of this out? So it's not just the investment side of things that we're here to focus on. And as we're talking about Roth conversions, a very specific part of financial planning, but everything that you see on the screen is what we're going to be able to offer you in detailed ways. And you work with us here on a quarterly basis. So just so you know, it's not just, hey, one and done, we're going to do this once. No, I know some of my clients are on this today, and some that are on there. We just recently went through your financial plan, and we were talking about cash flow rates and where assets are coming from now that they are retired. Very good, unique, detailed value add that we're able to provide for our clients. This is not the only conversations that we have. Part of our core disciplines is education to the public. And we do so in these forums. And as you know, these forums are also publicized on our website at bogartwealth.com. So everything you see here is part of what we call our Retirement Readiness series, which details a lot of levels that you need to be prepared for upon entering retirement, or if you are in retirement and just need a second set of eyes to make sure, hey, is this the offering I should be in, or do I need to contact Bogart Wealth to see how they could be different? Nothing is going to replace sitting down with a certified financial planner here at Bogart Wealth to help assess and provide you life advice for your financial situation. We're going to cover 4 big things today. We're going to talk about tax optimized accounts, those backdoor Roth IRA contributions, Roth conversion strategies, and then we'll have time for a Q&A at the end of everything. So let's jump into it. Like this fish is making his way over to the to the Roth IRA bucket here. Hope he makes it. Before we get into the details of understanding Roth conversions and the benefits it has for the plan, let's start talking about how we are traditionally saving into our workplace plans or our normal IRAs. In this slide, we're talking a little bit about more of the 401ks, your workplace sides, but what's the good part? What's the not so good part? So myself, saving into workplace plans, and I have been for many, many years. When we save into our traditional workplace plans, we are saving on a pre-tax basis. We all know this. We put the money in our 401ks or our 403bs. We're not taxed on it. That money is shielded from income taxes this year. And then we get that money to appreciate and compound over a very long period of time. So if we think about, if I have to make a decision about savings, I could put in a normal investment account. I'm already going to get taxed on it. And then I'm going to put in an investment account and it's going to get taxed dividends, capital gains. Or I could put in a workplace plan, right? It's all tax shielded. I'm going to get some tax incentives up front, lower my taxable income in this year. Well, because maybe we're in high income, we might want that right now. That's great. Like that's the really big benefits of, hey, I can help shield my money from taxes and get tax deferred growth. Let's talk about the other side though. Let's talk about the not so good side that we face with this type of saving, is that you need to get access to your assets. Well, the government's going to say, hey, you can do so if you also are, if you're under the age of 59 and a half, you're going to be subjected to a 10% penalty. Keep in mind, if it's like with your active workplace plan, a lot of times, unless it's some sort of deep financial hardship, you don't get access to your money pre-59 and a half because you're governed by their rules and restrictions. If it's with a former workplace plan, you no longer work there, typically you can get access to that. But if you do a distribution to yourself before 59 and a half, not only is ordinary income taxes, but also you're going to be assessed a 10% penalty. Then the government says, okay, if you're over 59 and a half, you need the money, you're in retirement, ordinary income taxes, both federal and state. Okay. State, if you have a state that actually has income taxes, shout out to Texas. When you also are saving, and if you don't need the money and you're just letting it grow, a lot of our clients have, built up a good bit of savings in their workplace plans. Come 73, or if you're born in 1960, 75 for you, the IRS is going to come knocking on your door and say, hey, you've had this money tax deferred for so long, you now need to take some of this out. These are what's called required distributions. If you've done detailed financial planning, you're going to know, is that going to be a problem for me or is it not going to be a problem for me? Because if it's an issue and all of a sudden your cash flow needs are X, but your minimum distributions are Y, all of a sudden the IRS is saying, oh, you got to take a lot more money out than you need to live off of. So why are we paying the taxes on that? Especially if I can look 5, 10, 15 years out, should I be thinking about getting ahead of that? And that's the topic of today's conversation. When we are saving in workplace plans, the IRS has certain limits that we can put in each and every year. You got probably familiar with what you can put in. These numbers have gone up slightly. 401ks, 403bs, and Roth 401ks, that is up to $23,000, up from $22,500 in the year before. I'm going to pause real quickly while I'm here because I want to see this word here, Roth 401k. It is one of the biggest things I have to talk to clients about, because a lot of times I hear, well, Brian, I make too much money. I cannot put money in a Roth 401k. I have that option, but I just never put it in there. Let's just pause here. You can put money in a Roth 401k regardless of what your salary is. That's the 401k. If it's the IRA side of things, yes, the IRA's got certain limits that you can put in on an annual basis depending upon what your income is. 401ks are different rules. There's no income limits as far as your salary or income about you putting in $23,000 into your Roth 401k. Catch up for individuals if you're over the age of 50, $7,500 a year. And then the maximum between you and your company you can put in is $69,000 a year. And if you're over 50, just add the $7,500 to that. And the maximum that can go into a 401k in this calendar year of 2024, $76,500. If you're not sure, do I do pre-tax money right now into my workplace plan, or do I do Roth money? Talk to us. This is what we do. This is how we're able to help. I was just talking to some of my my younger clients, lawyer, early 40s, higher salary, but we're able to assess that it actually still makes sense in the long run to just take the tax hit now because the time value is so large for this individual that we decided that Roth 401k is the best option. So if you're always curious about that, ping me. Let's talk about it. This is going to those traditional IRA contributions, those normal. As we talked about, those limits are a little bit lower, 7,000 this calendar year. If you're under the age of 50, if you're over, you can do the additional catch-up, which is another $1,000 that you can put in, and then income limits on the right. You can put more in if you have the Roth income bands are a lot higher. Just so you know, the income limits here that you see on the right-hand side is it only if it's deductible, meaning, hey, I actually want to put say $7,000 into my IRA. And if I'm, married filing jointly and our adjusted gross income is only 110,000, I could do a deduction. But if I make over 160, 170,000, I can't deduct it. I can still put it in there. That's just called a non-deductible contribution, which might be something we might want to think about if taxes could be an issue. We'll talk about that in a minute. That's those backdoor Roth conversions we'll get into in a few minutes. Okay. Roth 401ks, Roth IRAs. So we talked a little bit about the pre-tax monies, right? You're able to put those traditional contributions in normally in the 401ks, and if you do so, lowers your taxable income. But what about Roths? Don't do that. I don't get to lower my income by saving monies in my Roth plan, my Roth 401k. It's taxable. My salary is then taxable, and the net amount that I get, then I put the net amount after taxes into the Roth account. So I pay the taxes up front. But just like all tax deferred accounts, like IRAs, 403bs, 401ks, that all grows tax deferred, right? That's great. But the nice thing is that in the future, when you withdraw this, it's all tax free, completely tax free. Assuming that you've had a Roth for at least 5 years, and you're over the age of 59 and a half. So those are some of those are subjects that are there as well. They're not subject to the required distributions. So again, if those required distributions are going to be a problem, well, if you have money in a Roth, that's not a problem because that money is not going to be subject to the IRS saying, hey, we want to get our tax revenue back because you already did it. You already gave it to them when you made the initial contribution. Lastly, and this is, I'm definitely going to talk about this, but beneficiaries inherit these assets tax-free. When we're doing intergenerational conversations and running the estate analysis, a lot of it's not just what's the dollar amount that my heirs are going to receive, but whereas we're going to be able to see today, and a lot of my clients have seen before, is what's the sourcing of money that my heirs are going to receive, and what do they need to know, or I need to know for them about how the IRS might take more of that, meaning if I give them pre-tax monies, there can be some heavy tax consequences associated with that. If they get Roth monies, not so much. And then same thing with Roths, the same limits, $7,000, $1,000 for catch-up. And again, as I mentioned, the Roth limits are a little bit higher. It's up to $240,000, $230,000 for the full amount. And there's a phase up between $230,000 and $240,000. So if you make more than $240,000, say you make $250,000, you can't put money into a Roth IRA. But as we talked about before, you can do a Roth 401k. Okay, so Roth conversions. Can I do that? Isn't there some rules that are associated with it? No, there's not. That was done in 2010, which used to be, hey, if you had a certain income limit, you can't put any pre-tax monies and move to a Roth, but it doesn't matter what your income is, anyone can convert. The IRS just wants to get that tax revenue. But what it is, it's a penalty-free transaction where I'm going to pick up money from my pre-tax assets and I'm going to move that to this Roth source of money, and that movement, I'm going to be taxed at ordinary income at that level. That amount of money that I convert, say I move 50 grand from my pre-tax money to my Roth, that 50 grand that I convert, taxable this calendar year, or the calendar year that I do it. And so that'll be filing, you have to take a look at, do I need to file estimated taxes, or when do I need to make those payments by? Again, those are things that we help with and running those numbers for you, so we got you covered there. But yeah, it's movement of pre-tax monies. I pay the taxes now, and then it's in the Roth, and I don't have to pay those taxes again. I think the real big question is does it benefit you? The best way to find out if this is going to benefit you is talk to us. Talk to our advisors who's going to work with our planning team to assess, do these things make sense? And here's some of the benefits that we typically are going to see with clients, is clients that are looking to diversify their tax exposure. Maybe you're with a company that saved a lot of and you saved everything in pre-tax monies. Maybe you had like a lump sum pension that you rolled over and that's all pre-tax money. So all you're sitting on is just pre-tax money. Roth conversions may give you the opportunity of having different levers to pull if you have different expenses that might be coming up in the next, say, 5, 10, 15 years. Your income may have been too high before the changes in 2010. Maybe it's a thing that you think that tax rates are going to rise in the future and I'd rather pay it in today's rates versus the future. I have a belief personally about, where that might be in the future. I think it's always important to assess if tax rates stay consistent. Does it still make sense? Most clients that I've worked with over the last 17, 18 years believe that taxes are eventually going to go up in the future. I don't think I've actually talked to anybody, comment if you are one, that actually thinks tax rates are going to go down in the future for ordinary income. So that's actually, something that's important to think about is that, hey, if taxes are going to go up, I'd rather just pay it now and then, not have to worry about it again in the future. And then it's a part of the estate conversation. If you're thinking about, children and how they're going to inherit wealth, going back to that example of that individual that may be very top heavy in pre-tax monies, when either you or if it's you and your spouse pass away, those assets, those pre-tax assets, will have to be taken within a 10-year period. So if you think about, okay, a lot of clients I work with, we say guys like 60 to 75-ish, that's kind of the majority of my clients that are probably on this presentation today. Children are 30, 35, maybe even a little bit younger. But we think about, hey, when I pass, which is hopefully a long ways away, my kids are going to inherit this. Where are they going to be in their phase of life? And if they have to withdraw all of this money in a 10-year window, what is that going to do to the wealth that I want to pass on? Is it going to the kids for what I want them to use it for? Or is it going to go to the IRS? Real questions that we got to be thinking about when it comes to integrating our tax planning is not just today, but also how's it going to impact the estate. So knowing those rules, having an advisor that knows the rules and has the planning that can look at that is going to be really important. And I'm actually going to show you a couple visuals of what we show our clients and what some of those deliverables are. Other reasons, additional reasons to convert, tax rates are going to go up. If you think all rates are going to go up, I love this. If you'll be in RMD prison, that's just that. I don't know. There's the small things that make me tickle. That's great. Basically just saying, as we mentioned before, that hey, your cash flow is X, your required distributions are Y, and all of a sudden it's just, I'm paying way more money in taxes than I need. Again, these are good problems to have, good for you for being a good saver. But again, if you get ahead of it, look at the projections, then we need to figure out what the best thing is. This is interesting. So this is sort of our level of expertise, looking a little bit deeper at, okay, why does Roths make sense? We're going to highlight first the difference between the marginal tax rate and average tax rate. So when I make contributions through to my 401k, and if I'm making it on a pre-tax basis, that is done at the marginal highest tax rate. So think about this. If I mentioned I'm married, if my wife and I were exactly at $201,050, anything above that is going to be taxed at the 22%. Anything between that. So yeah, anything above the 22%. So, but if I did put 401k contributions on a pre-tax basis, it actually lowers that. It lowers that top part down. Nice. When I do withdrawals from the accounts, when I do withdrawals in the future, it's gone off my average tax rate because our system in the United States is a progressive tax system. So the first level of income is taxed at this, then the next one is taxed a little bit higher. But when I do withdrawals, it's just pro rata across the board. So as we'll talk about in a few moments, contributing money up front and then on the back end on the withdrawals, hey, makes sense, right? I'm going to be saving more at the highest tax rate. And in the future, when I do withdrawals, assuming I just keep everything in a traditional source, it's actually going to be a little bit lower. That's why people generally have contributed to pre-tax accounts. I'm going to be in a higher tax rate now, lower tax rate in the future. But let's just make an assumption here. Here's an example. Somebody married, they each earn $80K a year, so their marginal rate's at 22%. So they want to put $20K into their 401k. So they're going to do that. and they're going to lower their taxable income from the 160 down to 140. Great. Okay, so they're going to save some taxes. They're shielding that money from the IRS. They'll have to pay for it on the back end, though. Okay, what if they did a Roth, though? And still the 20K, but they got to pay $4,400 in taxes, so they're really saving about $15,600 into the Roth. Okay, so let's project this. Let's compound this over the next 30 years, assuming an 8% return. Again, we can change the returns all you want. So obviously you have more money in the traditional, so that's $2.2 million versus the Roth is $1.7 million. So, okay, first glance, Brian, makes more sense to do the traditional and not the Roth. Well, let's just think about that if we're now in retirement, need to do withdrawals. So assuming that you have a 30-year retirement, this person's living a long life, and we'll just assume they get 6% returns in retirement. Maybe their risk profile changes a little bit. And the traditional source, they can get $164K a year. The Roth, again, that's $128, and that's all tax-free. If we assume, though, that they're in a 22% tax bracket in retirement, again, the same tax bracket as they're in now versus in the future, they actually have the same amount of net money, meaning they would get $128 a year in the traditional source after taxes are paid versus the Roth. It's also the same. So where's the benefit? The trick is that we're just assuming here the withdrawals are done, every withdrawal is done at a 22% tax rate. But theoretically, if you remember this slide here, that 22% tax rate, the average tax is 17.1%. So actually, it's lower. So I'll be generating more by saving into the Roth. All right. Most Americans takes a very large RMD surplus for the average tax rate to surpass the marginal tax rate. All right. So we already talked about employer-sponsored plans. Let's talk about how much money can go in, and we're going to talk a little bit about some strategies about the Roth conversion, specifically how it works and how some of our visuals look. Again, we talked a little bit about this before, but on the right-hand side, if you're over 50, which I think the majority of you are, you can individually put in $30,500 a year, and then the between you and your company, $76,500. Should I convert? Quick little timeline here is, do you think you'll be in the same tax bracket when you retire? Answer is yes. Hey, do you think that's going to be at least 5 years? Great. Do you have enough money to pay out-of-pocket taxes for the conversions? Hey, Roth conversion may make sense. But follow along with this. If not, if you don't think you're going to be in the same or higher tax bracket when you retire, well, Roth conversions might not make sense. May not make sense, yeah. Time horizon's a little bit too short, meaning I'm going to have these required distributions next year. Does it make a lot of sense for me to do it? Maybe not. But we got to figure it out. And here's how we do it. This is where I spend a lot of time having conversations, not just with clients about their total tax savings, but also how they want to pass on wealth to their heirs. So here is an example of somebody that retired last year, and we planned for them, husband and wife, to live to the age of 90. This is a future value dollar that we assume that this client's going to pass away with $18,400,000. So when you work with your advisor, you're going to see that number, $18 million. Let's peel back the layers a little bit more and say, okay, out of that though, what's the sourcing of money that you guys are going to get? Taxable assets, think about non-retirement, that's your normal brokerage account, $6.3 million. Here's the rules. Your heirs are going to get a step up in cost basis here for the majority of assets. So if the day before passing in the year 2055, let's just say the day before you pass, you want to sell everything. And you have a cost basis of say $3 million, where you're going to pay the difference in capital gains between $3 million and 6.3. That's going to be taxable to you. But after you pass, if it goes to your heirs, they get a step up in cost basis so that if they sell it, their basis is the date of death. So if they sell everything, 6.3, their cost basis is 6.3. So that's a decent amount that's a decent way to leave assets to your heirs, and knowing that there's really not a lot of tax implications for them on receipt. In the future, any dividends, interest, capital gains that are created after you pass, yes, that will be taxable to them. But the biggest thing, capital gains rates, I mean, that's a lot easier, right? As you know, if you've watched our series before on tax optimization, we know that capital gains are typically a lot lower than our ordinary income rates. Let's focus on ordinary income taxes here, because if you look at tax-deferred assets here on the screen, you're going to see about $10.6 million in pre-tax assets. So remember what we talked about before. We talked a little bit before that these pre-tax assets, when they go to your heirs, starts a 10-year clock. A 10-year clock that this $10 million has to be withdrawn. So if you have 2 kids or 3 kids, say 2, 5.3 million over the course of 10 years. So if you just say, I'm just going to stretch that out and do it evenly, 5.3 million over 10 years, 530,000 a year. What's that going to do your children's tax bracket? I mean, that's, that just means, and again, where tax rates are today, where they could be in the future, where they're going to be in the future with their careers. I mean, a lot of that money could be gone, going to the IRS. Tax-free, this is the existing Roth money that they had, $1.4 million, completely tax-free. They have 10 years after you pass to withdraw it all. And that money's not taxable to them. Not taxable to them. So that doesn't do anything to their tax situation. So we're just going to assume here that we're going to do a conversion for this specific client up to a certain tax bracket. So that's usually what we do at Bogart Wealth. We'll show you, what if we convert to 22, 24, 32, so on and so forth. What are the benefits? What does it do to my estate? What does it do for my taxes? Here's what it does to the estate. Now notice number 1, total portfolio assets, 18.4 million. 18.4 million. Doing Roth conversions does not increase the size of your estate. A lot of times it can, but mostly it's usually around the same numbers. But what it does do is a sizable shift in the sourcing of money that your heirs receive. Instead of, 10.6 million in the previous example, pre-tax monies, 7.5. So now we're giving way less than ordinary income tax possibilities to our heirs. Here's $7.2 million of tax-free money to your heirs. So if we're thinking about the next generation, we're thinking about how can I influence the amount of wealth that my heirs receive, Roth conversion might be a real big part of that conversation. But that's just not it. That's not the only yes or no of deciding does a client do Roth conversions or not. How does it benefit you? I mean, let's face it, I hear a lot of times, my kids will get what they get, but does this benefit me? And I think we need to quantify if that works. So here's what we look at. We look at, okay, number 1, through the detailed financial planning that we're doing is, how does this impact required minimum distributions? So I'm going to do all my conversions before I turn. In this case, this person was born after 1960. So their required distribution age is 75. Look at here, top left-hand corner. They don't do anything, they get a $380,000 minimum distribution. In this case, because they converted up to the 22% bracket, we still got a lot of pre-tax monies. They're going to have a $243,000 minimum distribution. But over time, that number is very drastic, because if you don't know this, required distributions go up every single year, folks. Every year, that percentage amount that you have to take out is going to go up, regardless of what's going on in the market. So it's going to get more and more and more. And again, if you believe like I do that the markets typically over a longer period of time are going to do well, that amount is just going to go up and up and up and up. In this case, assuming 5.5% rate of return, pretty conservative, but it's $3.1 million less of required distributions that they're going to be forced to take out. How does this all relate to taxes, Brian? Like, what's the bottom line here? Does it benefit me? Does it not? This is usually a big slide that we talk to clients about. So the base plan, we're going to assume that they're going to live off their non-retirement monies first. And then in the future, when they're forced to, they're going to have to take the required distributions. That's the base plan. Look at the conversions. This is the amount of taxes that they're going to have to pay by doing these conversions. So it's an increase. So I have to pay more up front, but I'm going to get some benefit in the future. So right off the bat, 2023, if they didn't do Roth conversions, the planning tool, not my CPA, but the planning tool says they're going to be paying about $4,000 total in taxes. We're going to work with the CPA to determine if that's actually accurate or not, but we'll figure that out. The 22% bracket is, hey, I'm going to take pre-tax monies and move it over, right? This is going to be, this case, $179,000, and that's going to increase my tax bracket by about $37,000. Let's add that up over the next several years. Which makes more sense? Again, assuming that we live to the age of 90, that's going to be one of the placeholders that we're looking at. Assuming you live to at least 90, this individual is projected to save $750,000 in their lifetime in taxes. That's real money, folks. I mean, that's less money that's going to the IRS and more money that you just don't have to pay out because you paid for it up front. Visual about how your tax bracket can shift. This is going to be on the effective tax rate. So you can just see here, really in the future is where you see the benefits here. If you don't do the required distributions, look at the blue, just your higher amounts, and in the yellows if you did do the conversions. We're doing this off today's tax rates because, again, if you have an idea where tax rates are going to be and have that, I'd love to hear it. Your guess is probably just as good as mine. How long does it take to break even, right? Hey, we said, hey, you're going to save $758,000 over your lifetime. That's predicated you live to 90. You live longer, it's going to be even more. But for this individual, they would have to live to the year of 2047. And so if they were born, and they're looking at their mid 80s, that then it actually then makes sense, early 80s, that this break even point, hey, if you live this long, it's going to work out for you. A little bit shorter than that, well, maybe not so much, but it doesn't change how much your heirs are going to receive though, too. So it's also about the tax impact, but it's also about how it passes through your estate. So that's really the two big things that I look at in the planning tools about, if Roth conversions make sense. This visual here about, hey, marginal tax rate now, meaning while you're saving versus in retirement. For a lot of us, if we're going to be in, lower tax brackets in the future, maybe Roth conversions may not make sense. But if we are going to be in similar tax rates, or as that RMD prison, if you get locked in there, I mean, there is a get out of jail free card. It's called Roth conversions, but you have to think about that ahead of time. So again, if you're still saving, if you're just still a few years away from retirement or in retirement, but not till required distribution age, and you haven't seen this, let us know. We do the planning complimentary, by the way. We're not charging you to do anything. All right, so that is your traditional Roth conversions. For those that are still working, if you have a workplace plan that allows for I'm one step ahead, guys. Let's go back to the IRAs. Okay, let's do that. So IRAs, we talked about backdoor Roth conversions. Very, very important, especially if you're a higher income type earner, is anyone can convert. As I mentioned, there's no income limitations on, if you can convert from your IRAs anywhere else. Backdoor IRA contribution is where I can put monies into my traditional IRA. No matter what my salary is, I can put it in there. But I'm not going to deduct it, no matter what my income is. I'm just not going to deduct it. So I'm going to put my money into my post-tax money from my bank account, to my traditional IRA. That's the front door deposit. That's my, $7,000 that I can do this year. I'm under the age of 50, if you can't tell. If you thought I was, well, I got some work to do. Then if you're making that $7,000 IRA contribution, I can then immediately take it, and convert it to my Roth. It's called the backdoor IRA contribution. Just a quick pit stop in the IRA and then convert it to the Roth. The one thing you got to be mindful of is, do I have other IRAs? Do I have other pre-tax IRAs? Because if you do, the IRS is going to say, hey, let's take a look at everything you have, whether it's at Schwab, Fidelity, Rowe Price, wherever those assets are. If you got pre-tax money, they're going to look at that as an aggregate. And how much money do you have in pre-tax versus this sort of post-tax contribution you just made? How much is in there? Because when you convert, they're going to pro-rata that. So a lot of that conversion is going to be taxable. Here, if I only have monies in my workplace plans or any workplace plan, I can open up a traditional IRA, make the non-deductible contribution, and then very quickly thereafter move it to my Roth IRA and then invest it. That's a tax-free move. I don't get charged anything in taxes to do it. And similar is going to be with your 401k. We have a great series on the mega backdoor Roth strategies. Mike Camara and Misty are fantastic at explaining this. But in a nutshell, it's really the same thing that you're doing, is that usually at the end of the year, remember, 2024, you can put in $69,000 into your workplace plan. Okay. But I can only put in pre-tax and Roth, what do we say, like $30,500 if I was over 50, right? Between that and my company match, maybe that only gets me to, $45,000, $50,000. But I can put $69,000. How can I get more in there? If your company allows for you to do an after-tax contribution, whether it's along the year, I'm going to save an additional after-tax money to what's called an after-tax contribution, which is a non-pre-tax, a non-Roth source. Or maybe at the end of the year, I can just send them a check. Usually what happens is usually mid-December-ish, you call your record keeper, company that has the 401k, you say, hey, how much can I do in an after-tax contribution to get me up to that limit? And you send in a check. And then that goes into your more traditional 401k. And then what do? Like you just did with that backdoor IRA, you're going to do a backdoor to a Roth 401k source or to the Roth IRA, depending upon your situation and what your company allows. That is also tax-free. That's also tax-free. So there's moves that you can make regardless if you are, working or not, or if you are working, a lot of times like, I can't do these things. Check with your record keepers. Check with your companies to see if they can do this. And if you don't know, call me. Like we'll figure this out. We'll look at your record keeper and see what if they have these opportunities available to you. All right, so coming up to the end of this, this is Colonel Sanders' son. He's very happy with the financial advice that I just provided to him. His wife, Mrs. Sanders, is very excited because it's Valentine's Day. They're going to be set for retirement and they're going to be ready to go for the rest of their lives. So they're very excited. But nonetheless, all joking aside, this is where we can help with this one-on-one strategy sessions. These are all complimentary. The planning work that we do is complimentary. I know a lot of firms that are out there. If you want to sit and chat, that's great. But if you want to do the detailed analysis, they're going to be asking you for a couple grand to just run this. This is what I think a unique value prop is of Bogart Wealth. Let us do it. We're going to do it for free. The only ask is if we do a good job, you're going to continue to have a dialogue with us about your planning, and we'll keep up with you. And if you have any friends, families that could also use this, and we're doing a good job, that's our ask. Hey, refer us to people that can also use this help, because that's how we're going to help grow our business as well. Again, you can contact us. Best way for quickly, if you don't know anything about Bogart Wealth and this is your first time, bogartwealth.com. Go up to the very top right-hand part of your page and click Contact Us and send us a message, and one of us will be able to reach out to you. We also have a toll-free number on the page right here. But again, the best thing is bogartwealth.com. Contact us. All right. Thanks for joining, everybody. One quick question I got. What planning tool does Bogart use? eMoney. We use eMoney all the time. What we believe is one of the most premier financial planning tools. The way I describe it to clients, a lot of data you can put in, a lot of data you can get out. A lot of different alternatives that we run, certain things like Roth conversions, long-term care needs, gifting to our heirs, college saving. There's just a lot that you can do with it. And the levels of detail that you can get on the cash flow and tax planning page, I mean, to us, it's just, we just think it's a very valuable tool. Are the lines you were showing based on Monte Carlo simulations? No, that was a straight 5.5% annualized return, just for simplicity's sake, so we can see how that's going to work over time. So I hope that answers your question. All right, 34 attendees still with us. More questions. Here we go. What are limits for self-owned businesses? Self-owned businesses, it just depends on what type of workplace plan that you set up and how your company is established. If you're a sole proprietor, most individuals that I support will either do an individual 401k or a SEP IRA. Rules are a little bit different with Roth monies and dealing with that. There is some new law out there for self-employed 401ks and now have Roth sources, so more to come there. With SEPs, that's all pre-tax money, but after you are separated or retired, yeah, that's usually when you can start doing those conversions thereafter. And then the limits for that are the SEP IRA limits are going to be that it's 25% of your net investment income, or that maximum for the year, which is $69,000, whichever one is less. I'll stay on for a few more questions. Anonymous attendee is the one sending the most ones. Any good Valentine's Day traditions for you guys? No? I was out last night at 9 o'clock getting my kids chocolates, balloons, and little stuffies that my wife so graciously asked me to do at very last minute. But it was good. They liked it. They came down. They saw that. They were very excited for me to tell them they couldn't have candy at 7 in the morning. But they'll probably have that later tonight. All right, guys. Thanks for your time. I appreciate that. If you have any questions and you just want to kind of speak offline on this, don't hesitate. bogartwealth.com. Contact us is the best way to get in touch with us. This seminar should be posted back up on our website and in no time. So if you want to see a recording of it, please feel free. And if you have any friends, colleagues that this could make a lot of sense for them, send it to them, or send them my contact information. We'll be happy to help. All right, y'all. Thank you so much for very much your time today. Enjoy your Valentine's Day. Take care.